This is Blair's portfolio, and I want to do an update with you guys on my last video about margin and how to use it, and that yield max and all these other ETFs were scams. So I saw in the comments basically on the structures, and I know a couple people joined my Discord and they were asking, okay, what should I do? And I'm going to tell you guys what I did. I can't tell you guys what to do, but I can tell you guys what I did. So I'm going to be honest with you guys. I did a huge sell-off. I took a decent loss, but I did a huge sell-off because I just don't see a point in having your money in there and just waiting to get a margin call. There's just no point. I think people are hoping and wishing that they don't hit a margin call, but what we do know for sure is that we're losing all of our money, right? So I saw that I lost, I think around 14,000 or 15,000 in a day. I said to myself, well, I know for a fact if I stay in the market, eventually I'll get a margin call. I can sound cool and be like, oh, I have until 40% to lose to get a margin call. And then we see my portfolio literally lose thousands and thousands of dollars every single day. So I don't know how far the market's going to drop. But I do know for a fact that if I don't pull my money out, I'll get a margin call. So this is what I did. I'm just eating off of yield max, like I said, and that's why I have this picture up here. I sold off everything practically. So the only thing that I'm invested in is in my Vanguard account, but those are long-term investments. My Robinhood account is the income account that's leveraged. So that's the account where I'm trying to make it where the new way beats the old way of investing, of just investing in the S&P 500. So I still think margin is the key, but I think you have to be smart with margin. And I think all of us got a little too ahead of ourselves with these high yields and the margin and taking out loans and all this stuff. And especially if you took out a personal loan or something like that, you have to be smart about your money. Don't lose all your money. All right? You're going to get cooked. So I think the best thing to do right now is take all your money out, put it in SGOV or week or something like that, and just do puts on yield max. So that's what I've been doing. As you guys can see, and I have this up here, I've just been doing puts on it. I've been eating off of them, and then I do a stop loss. That's all I do, literally. That's all I've been doing. I've been getting paid every single day. Okay, cool. I'll do a put, stop loss. Once I'm in profit, and I will get in profit eventually because yield max has garbage funds, I'll put a stop loss. Even if I'm up 6% like you guys see, I'll put a stop loss. Get me out. Kick me out. Let me keep my money. So that's what I've been doing. And moving forward, I think the best thing to do with margin right now is only use 10% margin. That's what I think the best thing is to do right now. Unless you really need to use the money or something like that, or unless you're living off of this. But the best thing to do is use 10% margin. And did you guys also know that the first $1,000 always on margin is interest free? I did not know that. I thought that once you use the $1,000, after that, then it's not interest free. And if you guys hear a chewing sound, that is my dog. Hopefully it's not too loud. But yeah, I thought that if you use the 1,000, right, and then you pay it off and use it again, you pay interest on that. But no, the first $1,000 always in margin is interest free. That's a lot more useful than I thought. So I put this little thing together to I guess for the people that still want to be in the game, right? I think you should just wait, do sell puts on yield max, eat. That's what I'm doing. That's what I think. Take all your money out and just put a bunch of puts on yield max. Put a bunch of puts on yield max. Eat off them. That's what I'm doing. But if you guys really just want to get in the game, then I think the best thing to do is a DCA right now. Maybe buy one share every single day. One share every single day or something like that. And these are the ETFs that I think that you should use. I think a very large portion should be SCHD, because now I've learned that you need growth in your portfolio, no matter what. It don't have to be SCHD, it could be whatever you want, but I think SCHD is the ideal because it's a defensive stock. I mean, ETF is a defensive ETF, and then if you invest in something like XPay or QDTE or RDTE, SCHD doesn't hold anything of those, so it's something completely different. You don't want to double up on SPY, for example, right? SPYI, XPay, XDTE, SDTY, and then your portfolio is all relative to the SPY. Don't get me wrong, I think the SPY is great, but if you want growth, I think that growth should be different than what your income ETFs are, because the whole point of it is to stabilize your portfolio, right? So I think SCHD should be a very large portion. If you want to do XPay or XDT, that's fine. I also think XPay with SPYI or XPay with XDTE or something like that, combine those two. I think that's a good idea as well. And I also think that XPay is better than, what is it called? XDTE. So I think moving forward, I'm going to start putting more money in XPay. I realized that weeklies are great. Weeklies are awesome. But getting paid monthly is better. So my setup is going to be XPay, the curve funds, a little bit in XDTE, and week. And I'll also personally, I'm not saying you should do this, like AAPW, because Apple historically always goes up. And I think this Apple being such a stable and powerful company, AAPW would never go to zero. That's what I believe. I'm not saying it's a fact, but that's what I believe. So I have those as my weekly pair, so to speak. And then the rest of it is going to probably go to SCHD. And if you use only 10% margin, then that first 1,000 is interest free. So you're paying very little interest on this. Or if you want to be even smarter, just only use 1,000 and repeatedly pay it off. That's just free money. That's just free money, all right? So that's pretty much what I'm doing moving forward. And I also saw some comments that you guys want me to review some ETFs, which I will. I'll make one about BTCI. I saw a comment about that. I'll make one about SVOL, also one about that. But I just kind of want to give an update about this whole thing. And I think we all had our fun. We all had a bunch of money. We all were ballers. We all were about to buy Lamborghinis and Ferraris. You know, it's cool to say this. It's not to say on the statement, yeah, I made this much money. But I think reality came back. And we can still use these high yields and these high dividends to get ahead in life. But now we know what the reality is, right? Okay, we need to be a little bit more stable. We need a little bit more realistic portfolio. Not all yield max, not all round hill. Not saying that round hill is bad. Not saying that curve is bad, or rec shares or neos. But we can't go all in on margin. We can't do all this stuff. We need to be adults. We need to be smart about this. This is real money. And seeing yourself lose 20,000, 30,000, 50,000 in a day, I don't care how much money you have. No one wants to see that on their portfolio. Nobody. So, like I said, I think you should really invest in SCHD. And I also want to say, I saw someone say something about DGRO. And I don't think there's a point to invest in DGRO, because if you're investing in these high yields, they're all too correlated. You don't want your growth fund or your growth position to be anywhere connected to your synthetic positions or your income positions. They need to be separate, hence why I keep saying SCHD. SCHD is the Dow Jones, and it doesn't really have any tech in there, or REITs or BDCs, which is great because when all those other sectors fall, you have this one sector, SCHD, that's going to grow your portfolio. And again, that is only to grow it, because when you have these high yields pulling all this stuff out of your portfolio, you can say, okay, I know long term it's still stabilizing it and it's still growing it. But I want to know what you guys' thoughts are on this. I just kind of wanted to shed some light on this because I feel like my last video made people kind of hopeless. And people in my Discord asking me these questions like, okay, I don't know what to do. Like, I'm just totally screwed. So it's not the end of the world. I just think we have to adjust as investors. And we still do high yields, but we now know, okay, anything over 20% is a red flag. And it's fine to have 20%, but I also need that growth. So that's what I want you guys to take away from this. And moving forward, I'll make, reviews or my thoughts about other ETFs. So that's going to be pretty much it for the video. Let me know in the comments below, and I'll see you guys next time.